Tell us, what's something that investors should be looking for when we get this big report on the jobs numbers this Friday?
Look, Jared, first of all, always a pleasure from my side to be here on Yahoo Finance. The thing that investors should look the most for when it comes to Friday's jobs payroll report is the cyclical industries in particular, because any slowdown in the job market has generally been anticipated by cyclical industries underperforming when it comes to hiring trends. So we're looking at stuff like the construction sector, manufacturing, trade, any kind of cyclical sector in particular needs to be scrutinized pretty closely. Now, construction has been one of the major upside surprises in the job market this year, because as the housing market seemed to have slowed down late last year, beginning this year, one should historically expect construction hiring also to decline, and therefore the job market later on to decline more broadly. That hasn't really happened yet, and it's definitely an area of focus if you're looking at the non-farm payrolls numbers on Friday.
All right, I want to move on to the Federal Reserve. Just had a big decision last week, and I have a chart on the Wi-Fi Interactive. We got this from you, so it should be pretty familiar. This is Powell's favorite inflation measure. This goes back to 2013. U.S. core services taking out housing, and this is a 6-month annualized. You can see here, I'm going to circle this peak here in June of last year was 7.5%. It has crashed now to 3.3%, which is where we are now. Just tell us the significance of this and how the Fed might be thinking about this number.
This is very relevant, Jared, and for clients of the Macro Compass, I like to plot this chart even on a 3-month annualized basis. If you do that, the stickiest subcomponent of inflation that Powell himself referred to, so core services ex housing, is annualizing at 1.4% on a 3-month basis. So the sticky part of the inflationary pressures has really subsidized by now. And you have heard Powell as well in the last press conference for the first time talking about potential Fed cuts coming not when core sticky inflation is at 2%, but once core sticky inflation starts to become credibly on its way to 2%, that might happen way earlier than 2024, 2025. Actually, by the chart you showed, it's already happening. So this idea that the Fed will only cut if a recession comes, that the Fed will wait for inflation to get to 2% before cutting, I think it's a bit too far-fetched. The Federal Reserve is not the Bank of Brazil. It's not an emerging market orthodox central bank. They will look at cuts if core sticky inflation continues on this downward trend in 2024.
All right, so if core inflation is convincingly on its way down to 2%, let me just show another chart that we have here on the Wi-Fi Interactive. This is U.S. growth, nominal growth, versus the federal funds rate. This goes back to the early 2000s. Just tell me what we're seeking, what we're looking at here, and then maybe explain these dips below the purple line. The purple line is the U.S. Fed funds rate, that is a benchmark rate, and the cyan line is U.S. nominal growth.
Yeah, Jared, basically the point of this chart for my clients was to show them that every time you get U.S. nominal Fed funds above the trend of U.S. nominal growth, you're looking at empirically tight policy. So policy is biting. And you can look at 2007, which are circling right there. You had U.S. Fed funds over 5%, and nominal growth in 2007 was trending below 5%. And then you look at it today and you have Fed funds at 5.25 and US nominal growth on a 6 months annualized basis is about 3.5–4%. So again, you have Fed funds above the trend of nominal growth. When that happens, historically, policy is tight, policy is biting. And don't forget, the macro lags of policy having already been tight for 13 months and counting are obviously coming to bite. I think this is one of the reasons why Powell, but also other central bankers, see the Reserve Bank of Australia last night, are more hesitant at this stage. They won't really be super aggressive because they understand policy is empirically tight and the lags are also about to kick in. The risk now is that policy has become too tight.
And one more chart. I don't know if we have this, but I'm just going to describe it. You label it, what's the path ahead for U.S. equities? And it takes a look at the U.S. 10-year real yields, so that adjusts for inflation, and you compare it to the S&P 500 trailing earnings year, and that is earnings yield, and that is the inverse of PE. So explain what we're looking at right here and the significance.
So look, basically, when you look at equity markets, what you're looking at today is a situation where analysts are revising higher their expectation for earnings. You have earnings expectations for 2024 at plus 10 to 12%, it's a pretty solid earnings expectation considering that policy has been tight and remains tight. And then you're looking at valuations at about 19, 20 times forward earnings at the point when risk-free real interest rates are pretty elevated. In other words, we're effectively pricing equity markets to be picture perfect here. And obviously you can rally another 100 and 200 points, but my point is that both from an earnings expectation perspective, things have become more rosy, but also from a valuation and a risk premium perspective, things look pretty tight and optimistically priced as we speak.
All right, I want to switch gears. We got time for one more. Got to talk about Japan and a little mess they might have created over there. I want to draw everybody's attention to the Wi-Fi Interactive here, and I'm going to show what's been happening with the yen. This is a year-to-date heat map of all the yen pair crosses, or some of the major ones. What's green, the yen has appreciated versus the Argentine peso, 42%, but that is it. And it is devaluing against a host of other currencies. Here is a chart of the the yen US dollar versus yen, and it is right up to historically pretty high levels. That's a year to date. And I'll just switch this out to a 10-year chart, and you can see right there. So what's the significance of what's going on over in Japan right now?
So look, the Japanese yen is a funding currency, as it's called in currency carry trade. So basically, you short the Japanese yen because it's very cheap to do so. Interest rates have been so low for so long, and you go and buy some other currency that yields more, right? And effectively, we had a little bit of a change in paradigm there when we thought that the Bank of Japan would change its yield curve control policy and allow yields to get higher. So you would expect an unwind of that trade. The reality is that we are now in August. And so far, the new governor, Ueda of the Bank of Japan, hasn't really changed much. And even the last announcement is not really that significant because the Bank of Japan basically said, look, we are going to allow 10-year interest rates to move up higher than 50 basis points, all the way up to 100 maximum. But by the way, if the process becomes too vicious, we are going to stop everybody out. We're going to come into the market and buy bonds again. That's not really a very hawkish statement, isn't it? So you go back to an environment where the Japanese yen is not necessarily the currency that investors want because it doesn't provide you with any yield. Actually, you want to try and sell the Japanese yen to buy other currencies like the Brazilian real, which is still yielding over 13, 14% over there because the Bank of Brazil keeps rates very high. And that's this, tug of war basically between weakness in the Japanese yen and Japanese authorities on the other end trying to stop the weakness. But until they act decisively on the yield curve control, that's not going to stop.